this is Victoria from Adelaide Capital. So thanks for joining me today. So today I'm here with Chase Edgelow, the CEO of EverGen Infrastructure. So EverGen is a renewable natural gas company. They're nicely capitalizing on the decarbonization trends in Canada. They recently IPO'd just this August. They trade on the TSX Venture under the symbol EVGN. Hey Chase, how are you doing today?
Hi, Victoria. Thanks for having me. Doing great, thanks.
Yeah, I was really excited to host this webinar with you. I hadn't done too much research in the space previously to chatting with you, and a business that gets paid by both its customers and its suppliers to me was just fascinating. So I'm glad to have you on presenting. So with that, I'll let you get into the presentation and then we can circle back afterwards for a Q&A.
Appreciate the introduction. We're really excited about the opportunity as well. I think this is a business that we think is both sustainable in terms of its environmental impact, but also a sustainable business in terms of our growth plans. And really, to step back to the 50,000 foot view, what EverGen is a business that's focused on developing, owning, and operating renewable energy infrastructure. And our focus is in renewable natural gas. And what that is effectively taking organic waste. So whether it's municipal green bin waste from behind people's houses and homes, consumer waste from restaurants and businesses, or agricultural waste, we capture all of that waste at our facilities. We have the infrastructure to help it expedite the decomposition process, and ultimately we capture all of the emissions that otherwise would have gone to atmosphere and harness it into a fuel that is fungible with traditional natural gas in renewable natural gas. And that gets connected into the North American gas grid. We have contracts with the utilities of the world, the gas utilities of the world. And these are 20-year contracts at a fixed price that really underpin our EBITDA. So starting with that, we've got 3 facilities in British Columbia, 2 of which we've got long-term offtake agreements on, and the third is a future expansion project. We've got positive EBITDA today, but we're investing capital from our IPO and from additional debt capacity that we've got in our projects that will grow our EBITDA by more than 3 times to $12 to $14 million by the end of 2023. Why we like the space and why we've chosen to build our business here is for a couple of reasons. One, the North American gas utilities are going through their own energy transition, and they're targeting renewables in the same way that the electrical grid transitioned from traditional sources of power into the renewable space over the last decade. We now have a gas utility system that's looking to do exactly the same thing. So think of, in British Columbia, we have FortisBC. They have a 15% renewable natural gas target by 2030. And what that means is there's $2.5 billion of infrastructure is what we estimate that needs to get built to capture renewable natural gas from organic waste decomposition and really be able to deliver that into Fortis's system. What we like about that is that these projects are using proven technology. We're not a technology play, we're an infrastructure play. We're installing systems that exist in hundreds of locations across the world, predominantly in Europe and certainly in the US as well. And we're building projects across Canada. So we're headquartered in British Columbia today with growth objectives in Alberta, Ontario, and Quebec. So this slide really shows the cluster of projects that we have on the West Coast, and I'll jump right into some numbers here. The FortisBC program is a program to get 15% renewable natural gas by 2030. That is a program that's supported by the regulatory body and allows Fortis to pay up to $30 a gigajoule for gas. That's 10 times the sort of conventional natural gas price of the last 12 months. And it's something that they pay in these contracts on a fixed price, escalating with inflation long-term basis. So they really give the certainty of cash flow to developers like EverGen in terms of owning the infrastructure long-term, knowing that you've got a counterparty that's always going to take your gas. We currently produce renewable natural gas out of Fraser Valley Biogas. It's a project that's been producing for the last decade, and I'll I'll flip to the next slide here so you can see what that looks like. In the middle here, we have Fraser Valley Biogas. It's got 2 anaerobic digesters. These are effectively giant stomachs that process the organic waste and turn it into renewable natural gas. This facility we acquired in April with the view that we could double the capacity of the facility with a modest capital investment of approximately $10 million. And at the same time, we're also going to step into a new contract in that facility, and that will be a big game changer for the company is renegotiating a contract there that would allow us to take advantage of current RNG pricing, which is, as you can imagine, has gone up considerably in the last decade. The 2 projects on either side, Net Zero Waste in Abbotsford and Sea to Sky Soils, which is just north of Whistler. These are facilities that we acquired about a year ago from existing operators who were experts at processing organic waste. So what these facilities are is they effectively take green bin waste where we've got municipal contracts. That green bin waste gets dropped off at our sites by the municipalities, and it's processed into organic fertilizer in the form of compost. And that is a product that gets used by local farms. It's a circular economy type business, and it comes with its own contracted cash flow, which we like. But what we really like about those businesses is they serve as the base for an expansion project. And what we're doing at Net Zero Waste Abbotsford is we're building the renewable natural gas capture infrastructure to take that green bin waste and additional feedstock in the form of other commercial waste and process it into renewable natural gas as well. So we'll not only get paid to take the waste in on the front end, as Victoria mentions, but we'll also start to get paid for the RNG that we produce on the back end. So if I take a step back, my background, I started my career as an engineer in the energy business and was lucky enough to end up exposed to the infrastructure world, spending over a decade at Macquarie Group, which is very similar for those that follow the space to Brookfield in Canada. They own a ton of energy and traditional infrastructure globally. And what we were successful in was finding assets that had infrastructure-like characteristics, which really, for us meant contracted cash flow, but ultimately putting together portfolios that would allow us to capture significant growth for our investment. And that's the same opportunity that we saw in the renewable natural gas space, is to have that long-term steady cash flow underpinning the downside, and to have the upside in the fact that we can build a business of scale quickly in this space, and we can continue to invest capital in an attractive return. And so with my co-founders, Misha Zapman and our COO, Sean Mezzi, we started with a hit list of 3 projects that we wanted to acquire as the base of our portfolio in Canada. We've been successful on all 3 acquisitions. Sean Mezzi is our COO, who comes from a background in specifically the RNG space. He's been in the space for over 20 years. He's looked at over 80 projects. He's seen what works, what doesn't work, and he's built a team around really delivering low risk RNG projects, which is something that I'll touch on when we get to the comparables, is a real advantage for us. And Misha is a lawyer by background, spent 10 years at Blake's, and has subsequently moved into an entrepreneurial world. He really provides the discipline and structure around our business. Everything that we do, we try to contract, whether it's the offtake agreements, the feedstock agreements, the construction agreements, and then ultimately agreements to acquire and continue to roll up businesses across Canada. It really brings a tremendous amount of expertise there. In terms of our business, I really like this slide because it just simplifies things for anybody looking or new to the renewable natural gas world. On the left-hand side, you can see what comes into our facilities. Our facilities encapsulate all of the infrastructure in the box in the middle. But really, we take in your food waste, municipal food waste, agricultural waste, and organic commercial food waste, organics from that are typically collected by waste haulers. In each case, these are delivered to our site. We have some pre-processing that we that we do on that stream of organics, but ultimately it ends up in the anaerobic digester, which you would have seen as those green tanks on the previous slide. That digester acts like a giant stomach, and it digests the food, speeds up the decomposition process. Biogas is produced off the top. That biogas goes through an upgrading unit. This is RNG upgrading equipment that you might have come across, a Zeebeck or a Green Lane. This is the type of thing that they build. And it typically is around 10% of the capital cost of a project. So what we like about owning all of the infrastructure is it's a much larger play on the space and the growth that we expect to see in the RNG sector. Then that RNG that's now been cleaned up and purified from biogas gets tied in at the edge of our facilities into Fortis's network or Energier's network or other networks across North America, depending on the project. So this is it's a closed loop system. Everything that comes into our facility either goes out as RNG, or the other product that we make is digestate, and that gets applied to local fields as fertilizers or a soil amendment. It's a circular economy benefit for local farmers. They bring us manure and animal waste, and we give them back organic fertilizer that comes off of our digesters that's now devoid of any gas production. So I'll just pause there and take a step back to the front end of our process. So what's driving the tailwinds is not just the offtake agreements, but also the feedstock market. We've seen, if you look at this slide, all of the blue bars are traditional landfilling of organic waste, and the green bars are organic waste that's been diverted from landfills. We've seen BC lead the way in terms of diverting this organic waste. And why that's important is that organic waste causes a significant greenhouse gas impact. Methane produced from waste in landfill, that methane released to the atmosphere is 30 times more harmful than CO2. So it's a huge benefit to be able to capture the methane and channel it into the gas pipeline network and effectively offset carbon emissions on the front and the back end that would have come from other sources. So this is something that we've started to see really happen in BC, but we're seeing it happen in Ontario, Quebec, and Quebec and Alberta. And the benefit to that diversion is that the organic waste is now in a pure stream that we can use to process at our facilities. It also means that the municipalities need partners like EverGen to build that infrastructure. So we get asked why Canada. We've chosen to focus our platform in Canada, despite some attractive opportunities in the US, for two reasons, really. One being, in Canada, you can get long-term take-or-pay offtake contracts, which really de-risk the business, de-risk the spending of capital, and give us that sense. In any given year, we know what our cash flow is going to be based on the contracts that we have in place. That's one thing that you can't get currently in many places in the US. It's much more of a merchant market. And secondly, it's the competitive landscape. So just given the population density of Canada, the accumulation of organic waste, the way that flow happens, tends to lend itself to smaller projects. So think of $30 to $50 million developments. These are our bread and butter, and these are projects that are typically smaller than the thresholds for the large infrastructure funds that are chasing renewable investment. They're looking to deploy $100 million per project plus. So they really need a platform like EverGen in order to invest in smaller projects, and that's a real advantage for us. In terms of the market for gas, I think we talked about it. 15% by 2030 is approximately 90,000 gigajoules per day by 2030 from our math. That amount of gas production is going to require $2.5 billion plus of infrastructure build out. Fortis is currently out there as one of the buyers of RNG. Energier in Quebec has a very similar program, similar targets, similar volumes, and we're starting to see both provinces and states come up with similar programs. So there's a massive pull on the offtake side, and we think that market's going to remain strong for a number of years. So this slide is talking about our growth. We are focused on developing the first two projects in terms of expanding their capabilities and RNG production. those are the two projects at the top of the list here. So we've got Fraser Valley Biogas Expansion and Net Zero Waste Abbotsford Brownfield Conversion. And then we've got 4 projects that are a total of 18 of our targeted opportunities on this slide that would take us to 1 million gigajoules per year of output. Now, at 1 million gigajoules per year, if you're using an average price of $25 a gigajoule, that's $25 million of annual reoccurring revenue. And then we make about approximately 50% of our revenue from the tip fee side of our business. So there'd be another $25 million of annual reoccurring tip fee revenue on the feedstock side, or $50 million in total. And our EBITDA margins are at that 60% level. So that's $30 million of EBITDA. And this is the medium-term growth opportunity for us is to execute on those first 4 projects in our pipeline. So we're a small company today, but I think we're acting like a large infrastructure company in terms of the way that we execute projects. We've hit all of the milestones that we set for ourselves last year in terms of raising capital around the initial 2 acquisitions that we did, raising capital around the acquisition of Fraser Valley Biogas and closing on that transaction. And then we de-risked the development of Net Zero Waste Abbotsford by getting a contract with Fortis, a 20-year offtake agreement for approximately 500 gigajoules a day, which if you look at that annualized over the lifetime, that's an $80 million plus revenue contract. And then we went through the IPO process with the goal that the best way to consolidate this space, we've seen it in the energy space through the 2000s, is by being a public company and being able to roll in smaller private companies and give them exposure to the upside, as well as you'll continue to add accretive projects to our business. And I think that's really what we're excited about. So our short-term goals here, this is, forgive us, this is about a few weeks old here. We've actually hit the first goal here. We received regulatory acceptance from Fortis BC. We've just put out a press release this morning around our RNG production at Fraser Valley Biogas, and that's been a good news story for us since acquisition. The expertise of the team is really shining through in terms of being able to get an immediate bump in revenue and RNG production from that facility. And then we're focused on securing additional feedstock, improving operations, and starting to order the long lead equipment associated with the growth projects, the 2 large CapEx programs that we have in 2022. And then I think mentioned already, but the real game changer for us will be a long-term offtake agreement at Fraser Valley Biogas that is, from our perspective, underpinning the expansion of that project. And that's something we expect to have here shortly. So this slide I won't spend any time on. It's really a commitment of ours to be not only a sustainable business in terms of the way we grow, but an environmentally sustainable business. I think unlike others, this is inherent in what we're doing. It's not sort of an add-on or a bolt-on to our existing operations. So what I like to mention here is on the social side, I think we're really receiving a lot of the benefits of some of the previous work that was done around the facilities that we acquired. In particular, we're very proud of our facility just north of Whistler at Sea to Sky Soils, where we've got a First Nations partnership. We operate on First Nations land, and we have an over 80% First Nations workforce. And I think this has been a great partnership. We think we can replicate similar programs across other assets across Canada and really do a great job in terms of growing community support for projects that make sense in terms of capturing waste, but also make sense on the social side as well. So with that, I think can summarize where we stand today. We've got a very clean capital structure. We have a market cap as of today somewhere in and around $65 million, depending on the day. We've got cash in the bank to develop our 2 projects that take us into 2023 and deliver that EBITDA growth. That cash will be supplemented with approximately $25 million of debt towards our facilities. And we've raised in aggregate $60 million of equity. So I think what you can tell there, just doing mental math, is that our initial raise was done at $5 a share. So there was no sort of initial seed rounds below $5 a share. management and board owned the company prior to that initial raise, and we currently own 10% as management, 16% with our board, and we're locked up for 3 years from the IPO. So that is a commitment from us to grow this business. We're not going anywhere. We're not here for a short-term rise. We're here to build a sustainable infrastructure platform, and I think you'll see that from us as we come out with more and more news flow. On the analyst side, I think you don't have to necessarily take it from us. I think there's lots of research out there, which we're lucky enough to have gone through the IPO process to have 4 banks covering us, so 4 different sets of opinions. Their average target price is $10 a share. We currently are trading at $5 a share, and happy for you, anybody on this call, to reach out to any of those analysts. I think they all have done a tremendous amount of work on our business, and have a lot of respect for their knowledge of the sector, whether it's a utilities analyst or a clean tech analyst. There's a couple of different perspectives out there. I mean, in terms of what the upside is for us, we are benchmarked to a variety of different businesses, but there are about 7 companies out there today between the US and Canada that are focused in the RNG space in different ways. With our business, we're a little bit different in the fact that we're focused in Canada. We have some of the lower risk contracted cash flow versus the US market, which is tied to the LCFS programs and is more subsidy related. But I think good measure in terms of where we expect to be is trading north of 10 times EV to EBITDA based on our 2023 growth, which is really just our first 2 projects. It doesn't bake into the equation the additional pipeline projects that we're focused on delivering. And I think we can deliver in the same way that we delivered 3 acquisitions in the front half of this year. We're looking to continue to maintain that velocity now that we're through the IPO process. So with that, I'll turn it back over to you, Victoria. I think that's our business in a nutshell. I wanted to leave some time for questions, and it's from our perspective, it's a simple business model, because there's a lot of really good tailwinds. We don't need to overthink it. We just need to execute in terms of adding assets to the system and delivering on the assets that we own.
Yeah, no, thanks so much. You guys have definitely put together an interesting package of assets in a pretty short period of time. So congratulations.
Thank you. Yeah, it's been running on a tightrope in some respects, just getting the whole business to a point where processes and workflows are in place. But I think we're at a point where everything's been established now, and we can maintain that growth.
So I'm just going to remind the audience, there's a Q&A box at the bottom of your screen. If you do have any questions, we will get them answered. So Chase, I guess, just starting, could you provide your views on the sustainability of pricing for RNG? So it is, at quite an attractive premium at current levels. And so just what do you see in terms of being able to, contract new projects at the same levels?
Yeah, this is a space that the private capital is really paying attention to, whether it's pension funds or infrastructure funds. They're all looking for ways to own renewable natural gas infrastructure because of the dynamics that you're describing. So if we look to the US, I think it's a good example of what a real draw on RNG looks like. Their projects, if you have a low carbon intensity project, or in our case, our facilities are actually carbon negative. So the reason for that is that the gas captured that would have otherwise gone to atmosphere would have had a much more harmful impact than any of the carbon impact of building a facility or burning the natural gas at the back end. That negative carbon project is so valuable that we're seeing RNG trade at $60 to $80 a gigajoule versus on the spot market versus where we're contracting at that $30 a gigajoule range. What we like about the contracts is it's there for 20 years. It's not a short-term market spike. And we still have the ability to take advantage of that short-term market. Any additional gas that we produce above our contracted volumes, we have the ability to send into other systems, provided that there is capacity there.
And then what about on, the organic material side of things? So those contracts are much shorter duration than on the the offtake side. So do you see any risk with that kind of pricing or those duration of contracts?
Yeah, so it's something it's a great question. It's something we spend a lot of time planning around in terms of acquiring assets, developing brownfield projects. Part of the reason that we targeted our first two assets were the fact that they had existing contracts with municipalities and that they were in regions with high tip fees and dynamics around that feedstock contracting that we believe is going to only put upward pressure on pricing. And the reason for that is increased diversion, more feedstock than there is capable facilities in the region. In the long run, if RNG prices in the US stay at $80 a gigajoule, we're gonna see an imbalance of revenue shift from the feedstock side to the RNG side of the business. That's certainly something that could happen. I think what we'll see is the pricing settle out and a bias towards long-term contracts.
Okay, so your answer just fed in very well to two audience questions that I have. So one is just you're primarily dealing with municipalities for feedstock. Are there other sources where you can get feedstock from, or that you do get feedstock from?
Yeah, the three areas that we focus on are the municipal side. The restaurant and commercial food waste tends to be collected by waste haulers and then taken to third-party infrastructure like ours. So we look at partnerships with the waste haulers that pick up waste behind restaurants, call it your waste managements or GFLs of the world, or smaller operators. And then the third piece is the agricultural waste itself. So manure has a huge carbon footprint. So farmers that are looking to offset that, providing manure directly to our projects, that's what we do at Fraser Valley Biogas. Is we're a source or a sink for manure for local farmers and agricultural waste directly. So these are your byproducts of the agricultural community.
And then you touched on this kind of briefly in your last answer, but looking down the road 1 year from now, what percentage of your revenue do you expect to be from tipping fees versus the offtake side from RNG?
Yeah, so in our both of our expansions, well, we're fully up and running in 2023 with both projects producing at their full capacity. We'd expect to be in that 50-50 tip fee and RNG revenue range. I think there's a bias towards, if we produce more RNG, for more towards the RNG side of the business. But I think it's that balance that we look to strike in the areas where we do projects.
And then on the projects that you're developing, are there risks of cost overruns due to inflations or delays getting equipment?
Yeah, it's a great question as well. I mean, we're looking at the impact of COVID on the supply chain globally. I think for that reason, we've come up with a few strategies to ensure that we've got long lead equipment that's going to be there when we need it. So it's something we're definitely taking into consideration. And what's helping with that is the traditional builders of this infrastructure were relatively niche. Because of the growth that we've seen in the US, and in addition, the value that the traditional energy businesses that make your gas upgrading equipment that have seen the opportunity in the RNG space, we're seeing a lot more contractors and third parties that provide equipment come into the space and drive a greater supply chain.
Okay. So I wanted to chat a little bit just about, your pipeline via acquisitions. And so what point of a project does EverGen look to get involved, in a new project? Do you guys have a sweet spot where you guys typically like to come in and invest?
Yeah, there's three types of projects that we look at. I think one would be your optimization of existing infrastructure. So we put Fraser Valley Biogas in that bucket. There isn't a ton of existing RNG infrastructure in Canada, but there are some projects where traditional biogas was taken and it was used as a means of producing power. So there's projects where you basically have biogas to power that are interesting optimizations. The greenfield projects, we tend to come into projects when we would say they're on the 50-yard line. So there may have been a smaller developer that's been successful in securing a site, getting permits, but they don't have the technical expertise that we do on our team to understand what equipment they should be putting into the development of the project, or how to even design a project in a way that you're going to have the operational resiliency. So that's usually when we get introduced to the conversation. And then ultimately it's our ability to provide capital to the project, because the projects are smaller. The options for $100 million wind and solar project, they can go talk to the Brookfields, the Macquaries, the Northland Powers of the world as a partner. On a $30 million RNG project, there's not that many companies out there that understand the technical risk. And so it's for those two reasons we get involved. We also like that because we get involved when a project's been de-risked and the timeline's been accelerated. So we like to get involved in projects that have that, that 1 to 2 year lead time, rather than a project from scratch that could take 3 to 5 years to get to fully operational.
So what does the competition look like then for you guys when you guys are out, bidding on projects? Who else can they talk to?
So if we look, obviously there's the public peers that we talked about. I think for the majority of those, their business plan is focused on the US. The other private capital, there's private equity that looks at projects on a project by project basis. They tend to want to invest when things have been fully de-risked though. So there's usually a gap there that they're less comfortable investing in a project on the 50-yard line versus a project on the 100-yard line. I think the goal line, if we're talking about football analogies. And I think the other source of competition is really developers doing it themselves. So smaller business owners, existing farmers that build projects. That's a good example of that was Fraser Valley Biogas. It was a project that has been was built on a budget, and I think had it been built today, it would have been a different amount of capital invested, and it would have a lot more cash flow than it does, and that was the opportunity that we saw.
You mentioned Sean's bio at the beginning and just the experience that he has in terms of, looking at these projects. So what kind of an edge does that give you guys also?
It's a tremendous edge. Misha and I, when we met Sean and we were looking at the space, in almost every conversation around a project in Canada, Sean's name came up. And that's just telling, because he was focusing most of his time in the US at the time, looking at different projects, working with some of the large private RNG companies. There's a couple that are $1 billion in size and scale in the US that are still private. And he's seen what works. He's seen what can trip up a project through the construction phase, and he's seen what can trip up a project through the operational phase. And the goal with this is to build infrastructure that's flexible, that's reliable long-term. And I think it's akin to building a wind farm that faces one direction. If you've never built a wind farm before, or we're talking 10, 15 years ago, versus the new wind turbines that, can pivot and change to any direction of the wind and still have the same sort of power generation. So it's a measure of technology, picking the right technology to handle the local feedstock, and then building enough flexibility and reliability that you're going to have a long-term stable cash flow profile out of an asset.
And does it ever make sense to come in and start your own project entirely new versus, looking at what's out there on the acquisition side of things? Or is it always make more sense just to, kind of buy something and get in that way?
We're looking at a couple of greenfield developments. So we like to have a portfolio approach. I don't think, between greenfield, brownfield, and partnering with developers, there's no particular bias. I think we try to find good projects and go after them with the same emphasis that we've gone after our first 3 acquisitions. And I think we're certainly spreading out and looking at all 3 types of opportunities.
And then just another audience question: Are you looking outside of British Columbia at projects?
So we are looking at projects in Ontario, Alberta, and Quebec. We get shown the odd international projects in the US. I think Canada's still a focus for us because of all the reasons we've talked about, because of the feedstock dynamics, because of the RNG offtake contracts, and because there's still a lot to do here. If we look at the projects that are required to get to the volumes that the utilities are targeting, there's 100+ projects across Canada that need to get built, or a couple mega projects. The challenge in Canada with mega projects is there just isn't the population density to really give a project like you might see in New York City, $100 million plus projects legs. I think we're going to see a lot more smaller projects to get to the targets.
And then what would you say to people when they talk about the US and they talk about, the size of the projects in the US and they're so much smaller in Canada? How do you guys get that same type of scale? Or I guess, what would you respond to that type of response when comparing the two?
Yeah, I think it's step by step for us. We've got a pipeline of smaller projects today, but at the same time, we're in conversations with some of the larger infrastructure funds and investors that want to co-invest with us on projects. So if we do come across $100 million project, we can attack that with as an operator and as a technical expert and an ultimate co-owner of a project, but we can bring in other outside capital to fund a larger project. So we'll look at that. The returns tend to be better on the smaller projects. So that's where we're tending to focus our time today, but not to say that won't change 2 or 3 years down the road as we continue to grow. And there certainly is that ability when you're a $1 billion company to continue to grow at the same rate that the independent power producers are growing their businesses.
And then you mentioned, the offtake that, 90 million cubic feet a day was going to be needed. When you and I were chatting, you had given me some context, and I can't remember the number you said, but I thought it was interesting. You said 500,000 cubic foot a day, for reference, would be, what was it in EBITDA?
It could be a project that's in the sort of $6 million EBITDA realm, including the feedstock revenue.
Right. And so that was for 500,000 cubic feet compared to the 90. Okay. Just
to
get
so you sort of think about that, that's
the size
over $1 billion sort of EBITDA market out there in the long run, that I think we're a first mover on today. We want to continue to be that first mover. I think we're currently the only platform out there that has 2 offtake contracts with Fortis as an example. And with Sean's expertise in the sector, there's really long-term relationships that that help build businesses, whether it's on partners at the municipal, provincial, federal level. I think it's really about having been in the space and understanding how to maneuver.
And then you mentioned too, $20 million of cash in the bank. You're going to fund the remaining 25 million of your CapEx for your expansion projects via debt. What is the right level of leverage to, put on these projects, and what are your peers doing, and how do you guys compare?
So we've looked at a couple of projects that are proposed to be 100% debt funded. I think that's probably getting up there. But when we look at what lenders are typically comfortable with, they're usually in that 60 to 80% leverage on a particular project with non-recourse funding. So for us, $25 million, plus we currently have a facility with a subsidiary of Scotiabank, Roynat, that's at $7 million. So we'll have just over $30 million of debt. And we've put into the ground $60 million of equity. So it's at that sort of 30% level. I think 50-50 long-term makes sense for the profile of assets that we're looking at.
Okay.
So ample debt capacity to continue to grow without having to come back to the market for projects 3 and 4. And
then what about grant funding?
Yeah, that's something we didn't touch on, but it's been a focus for ours lately. There are a number of programs out there. Some of them offer up to 30% of project funding through grant programs. So the Canadian Clean Fuel Fund is a program that is currently in place. It's specifically geared towards fuels like ours and projects like ours. So we think that's a big source of upside, is to be able to get that type of grant funding, whether it's in the form of a zero interest non-recourse loan or effectively true grant funding. I think it just provides that additional firepower for our projects. Okay.
I just want to remind the audience that there is a Q&A box if you have any last questions. Chase, what should we be looking for over the next 6 months? What type of catalysts are on the horizon, and what should we all be watching for on our screens coming out from you guys?
So this is for us heading into a period of a lot of activity. So I'd be watching for us, contracting some of the long lead equipment, getting into partnerships with equipment suppliers on the development of projects. The Fraser Valley Biogas contract extension or renegotiation, that's something we're focused on now. and there's a big impact to our business when that happens. Effectively, we'll get a bump up in the revenue per gigajoule that we sell. We'll also get that certainty in terms of 20 years of contracted cash flow from that. And then on the M&A front, I think we're focused on a number of acquisitions and projects today. You necessarily can't predict the timing of those, but as I said before, we're going to be focused on delivering those in the same velocity that we had before. So whether it's a couple of announcements in the next 6 months or more, I think you're going to see us be active on the M&A side of things as well.
Okay, yeah, well, thanks so much for joining me. I really do think, it's such a unique opportunity. You have this low risk profile with these stable contracted cash flows, on one side of things, but then you also offer, that attractive high growth profile on the other side of things. So yeah, I think it's really unique and rare to find an opportunity, like that these days. So I guess I'll leave it there unless you have any final words you want to leave everyone with, but.
No, we didn't see anything out there like this. This was the type of investment that we wanted to be involved in ourselves, and so we went to work building it, and we're incredibly proud of what we built so far, and appreciate your support, everyone on this call. We're glad to be telling the story, and hope to see some of you potentially individually in the next 6 months. Happy to take any questions as well through Victoria if there's any follow-ups.
Yeah, and if anyone does have any follow-ups, please feel free to, reach out to me, and we'll make sure that we get all of your questions answered. So Chase, with that, I guess I'll end it there, but thanks again so much for joining me. So really appreciate the opportunity to get an update on the story.
Thank you. Thanks, Victoria. Thanks so much.